Well, hello everybody again. It's Matador. It's still April 23rd, and I wanted to respond to some comments, some very nice comments that were put on April 22nd, yesterday. And let's go down the list. Pretty nice to be doing this here with you guys again. So here's one. Logged in to say these vids are great stuff for folks like me. Thank you very much. So reviewing both macro and micro snapshots keep me from getting tunnel vision. With the volatility these days, I use stops, but the frequency gaps up and down, they become almost useless. Any suggestions for dealing with those? And this actually, to me, gets into an idea of time frame and how I'm going to trade off that. So if I'm looking at a charting package or something, let's say that I'm looking at a daily chart. A lot of times, people will trade a daily chart for swing trading purposes. If I zoom in here, make it kind of big or whatever, you've got swing lows and swing highs in here, right? You can see the momentum kind of shifting as we run into this massive resistance back in here. Again, we're sort of fighting that. There's no accident in a chart, so it's fine to see this momentum slowing. We just don't want to see it break. Or if it does, we want to see a higher swing low and work our way out of it for the broad markets. But with all that being said, if I'm going to trade off of a daily chart, then I'm looking for patterns that shape up on a daily chart. For instance, a high base like this. And I watch them very, very carefully. And so just to take this exact picture, just for fun here, if I decided to get into a high base breakout situation, I think the stock's got a X chance of making it to the next logical place of resistance. I know where I'm going to put my protective stop, which might be in this case below the high base low, which is where this blue line is right now. That would be one idea for that. You would also then get the 100 MA. Well, look how far away that is, point value wise. You could check percentages if you wanted to. But if you look at this, so 82.50 all the way up to 87.50. Right, so just to make it easy on me, so that's a 5-point difference. Well, if you were looking intraday on a 15-minute chart, right, and you're looking for a setup, well, your stop isn't likely to be 5 points in difference. So the next day, if you're holding a stock that you found an intraday pattern with, it can very easily be gapped above or gapped down below, and you would take a larger loss than you were thinking that you were going to, because it would gap past your protective stop. It still triggers and goes live as a market order, but you're filled at the market when it opens the next day, right? So that's what you're talking about when a stop gets gapped on. But if you're back on the daily chart, I'm not saying it can't gap down dramatically, but it would take more of a move to have that happen. What's tricky here is if you have a wider stop, you can actually keep the risk the same just by owning less shares of it. Does that mean you're going to make as much money when it goes in your favor? Not as much, right? But your risk reward would still be the same. All the other things are the same money management wise. The dollars at risk would be the same. If you, and your chance then of getting stopped out goes down because you have a wider stop. Take this stop and make it very, very tight. Now you can own lots of shares, have the same amount of risk with one caveat, which we'll talk about. Then if it goes up, you make a ton of money. But your chance of getting stopped out goes through the roof. And it's inherently more risky because what have you done? You've bought more shares. Then if it does gap way down, you're soaked. All right, so even having a stop that's wider like this, all right, every time you lower your share size that you buy, your inherent risk drops because the total amount you can lose is the total amount that you paid for it. And that goes down when you lowered the amount of shares you bought. So again, even if you want to buy tons and tons of shares intraday with a really tight stop, be careful because your risk is rising. Even though it might think you're going to get stopped out, it's only that 1% of the time when you were absolutely wrong that you get mangled, and you want to try to avoid that. So that's just some thoughts on time frames and intraday work, and then also trying not to get gapped on so much. Just keep wider stops if you can, if it makes sense, and lighten up your share size. That's usually one way to avoid that. All right, next one. So here's a question or a thought from somebody about the market internals, and they're currently using Fidelity Active Trader, but maybe it's not that great. So where do I get it? I use TradeStation, but there's another great one you can get for free, like I've been sort of touting, and that's Thinkorswim. You can actually get that charting package for free. Do the first initial steps of opening the platform up. And then later on, if you decide that you like them, you can use them as a broker. That's part of their little sales package, which is, to me, fantastic. Give people what they want. Do it for free, see if they want it, and if they do, then they buy it, and you've got a great relationship going forward. That's a pretty nice business model. And you can use that to your advantage and look at all the market internals right in there for free as well. And the last one in here, thanks again for the videos. Since trend lines are such an integral part of technical analysis, when drawing them, is it better to connect the tops and bottoms of the candle bodies or the tops and bottoms of the candle wicks? Or does it not matter since they are more or less represent approximate zones and not precise points? Well spoken. There are actually some really cool tricks I'll show you here just now on how to assess whether something's relevant or not and how I'm going to choose to draw my trend lines through it. There's nothing like a precise point in the market. There are always areas, but there's some cool tricks. So let's go and look at a daily chart here. We've got the spiders up. So if I want to know how significant an area is for drawing a trend line, and I grab a trend line and I throw it in here, I could easily do this, right? That's a really good one. I could move this over here, grab this guy and kind of move him like so. Right now it's sort of a straight line between 2 points. Or I could cut that tail off. I could do almost anything I want. What I'm ultimately doing, just to back up here, is looking at the relationship of the swing highs and lows to each other. All right, so that's a very, very important thing to do. That's why I can tell the sentiment read of this chart without looking at any secondary indicators. I know that MACD is rolling over, giving me divergences most likely. So in here, however, let's take today. This is a good indicator of what I'm talking about. So today we had the stock open right there. And either traded higher or lower first, I don't know, I don't care which. But I know at some point it put in a low that was unsustainable. I'll just zoom in here. This unsustainable low then came all the way back up, forming this hammer-esque kind of pattern, and to close a little bit above where it opened. So if I look intraday, I can now fine-tune that lower shadow. And I'll know whether I want to cut it off. In other words, did it open here and then sell off quickly and come right back up and then trade higher? Or did it open where it did, trade lower all day long, and then run up here at the last 5 minutes of the day? Both of those scenarios and anything in between could form that same candlestick, and that would be very different as to how I would read that lower candle. Same thing for this upper shadow or any others. So if we go look intraday at this chart, scrunch it up a little bit. All right, so huge sell-off yesterday, giving up almost all the gains that we had made. Little gap up this morning, sells back off. We had this little rounding, this loss of momentum, and we worked our way higher almost all day long here into the close, which is pretty dramatic for it to be able to close higher than it's open. So now I know, to my eye, this is significant. This is an inverse head and shoulders pattern right here. You got shoulder, shoulder, head. There's a higher swing low right here. There's a cup and handle. So that's dramatic enough for me to want to drop a line right there. Right, so that's the 83.68 area. Right. So I go back out to my daily chart. I know that 83.68 is right there. I'm going to include that lower shadow into my trend line analysis, definitely. I'm not going to cut that off. And you could go find another scenario where a lower shadow didn't have very much price data, where it had gapped up, sold off dramatically the first 5 minutes a day, come right back up, and chopped around higher all day long. Now I don't care so much about that, and that has to do with support and resistance reads, which is maybe for later. But good stuff. That's my little diatribe on to how and when and why I would use shadows or when I wouldn't, and that makes a lot of sense. So very cool. One more. The pre and post market data, is it available on EduTrader? And right now I don't think it is. I'll check that out with somebody and find out, but I don't think so. So very good, everybody. Great comments again. Here's your reward for being brave enough to put anything in here. And you're probably asking questions that other people are wondering. So it's very helpful to the whole community here. So again, have a great rest of the night, and I'll talk to you guys tomorrow.